Hi, everyone. Welcome to Watch Your Six. I'm Jason Edwards, and nice to have you join us during this podcast. I thought in our beginning opening monologue, we talk a little bit about markets and market bursts. When you have a market that is very robust, doing very well, the natural indication for clients are, well, what's going to happen next? We know no market continually goes up, and we know no market continually goes down. We've discussed that before. But what's interesting is there are some statistical resources and models that have been used over the years to sort of describe the burst. There was a gentleman by the name of Kindleberger who was an economist, actually during the Great Depression eras, and he was really good at describing the methodology of what a bubble, a burst looks like, and how it comes to fruition. So how does it evolve? So what he brought out was that with any investment market, and when you have a very, very robust investment market, like we've said before, a market that's growing up, you had to start with some kind of innovation. So in our world, it's been very common technology. Right? AI is now an innovation. It could be financial monetary policies. Companies or countries change the way they do money. It could be a dynamic where you've got manufacturing, new railroad, transportation, whatever it is. But that innovation takes off. It gains momentum. And as it gains momentum, it gains money. And now investors start to get excited about that innovation, right? And they start to get a little giddy and like, man, this is great. And what you'll see with most market corrections or crashes or contractions is that there comes a point where the euphoria of the investment exceeds the benefit of the investment. So many of us experienced this during the tech bubble in the late 90s or the real estate bubble. People were so excited to invest in technology, they stopped looking at what they were investing in. They didn't care. They just invested in everything. And you have, positions and investment portfolios that were trading at, 10, 15, 20 times what they really were worth because people were excited. So euphoria took over, and the credential way of people looking at that dynamic, they had a situation where logic went out the door. You have multiple investors piling on. And what happens is that particular investment starts to become overweighted. You've heard that term before, meaning there's more money going into the investment and more resources than your earnings or than the company and the benefits of that company justify. So again, what happens now, we've got an overinflated popular thing that's taken off, and that overinflated popular thing that's taken off starts to have some air deflate out of it. Well, if you're the individual who bought, let's say 2 days before the air comes out of it, you've paid a lot of money for that investment, more than the investment might be worth. And as that air comes out and that ship sort of sinks and gets to the point where it's really worth, that's when you see what we call the market correction. So you experience that downturn. What do you naturally do? Well, if you're an investor who's focused on things emotionally and really didn't think about it, you start to panic. So your natural reaction is, I can't lose my money. What do? Well, you sell. Well, the next guy sees that and he sells, and then he sells, and then he sells. And before you know it, you've got a sell-off. Now you've got a market crash. And that all was created because of the cycle of markets and how they grow and the lack of understanding. And more specifically, will you have the environment we see today where you have a tremendous amount of data traveling at a tremendous amount of speed. That market correction and expansion can be very fast. They speculate that there's over $4 trillion a day trading on day trading. Now, if you add the AI model, you now have a dynamic where it could be much higher. You also have a dynamic, according to Morgan Stanley, that estimates that over $30 trillion is going to be invested in AI-related investments or infrastructure. So when you've got that kind of robust environment, it's natural for you as an investor to say, you know what, I'm really excited about it. Well, now we get into that, again, that model that was set up by the economists we referenced earlier. There's an innovation. We get excited about that innovation. That innovation continues to grow, and we start putting money into it. And we may put money into something that's maybe not worth it. So it's really important that when you do that, you take your time, you take a step back, and you look at the investment and you try to determine some things about the investment. First of all, how long has it been around? What's its projected earnings? Where does it come in when it comes to its peers, its benchmarks? Does it exceed the benchmarks, or is it below the benchmarks? These are all investment considerations that you have to be careful of because, again, it's your money. And we don't want to be investing in something just to say, well, I'm buying an AI, I bought into semiconductors, I bought some large cap. It's a little more granular than that. So when you get granular, you want to make sure that you understand the nuances. A good example, there was a stock position called JDS Uniface. You may or may not have had it in the 90s. It was trading $180, $190 a share. Obviously, it crashed, and you'll never get back to those price points. It's so far off the highs. So the individual that invested at that high bar mark or the high water mark is going to be stuck with that loss. So we always talk about take your time and sit down with your team. If you're looking at an investment, you want to look at the investment. Remember the core things we touch on. First of all, your time horizon. How long are you going to spend when it comes to that money? If I'm investing this money, do I need it in a year, 2 years, 3 years, 10 years? That makes a big difference. If I've got a 10 or 15-year window, I can really ride a lot of market corrections, right? I can take advantage of that. I can be a little more aggressive. If I've got a 1 or 2 year window, I can't afford that because if the economy collapses, then what happens? Well, now I've got a dynamic where I'm out of pocket and those resources aren't available for us. And the other thing to understand is that when you buy into a high-priced asset, it becomes something that can be a contagion. What do I mean? Well, other people bought in that high-priced asset, and as I said, when that market corrects, it doesn't take a lot for people to panic. So if they paid $100, $200, $300 a share for an investment, and they start to dump out of it, now you're stuck with that environment. So these are things that you want to make sure you're aware of when it comes to investing. Now, what are some of the ways that you can protect yourself against these kind of things? Well, first of all, never put all your investments in one category, period. Sounds simple, sounds very common, but it's not really something that people follow. There's a term called diversification. That's just a big term for splitting your money up. But more specifically, you should split your money up more effectively. So you want to move that money around. So let's say I'm going into AI or I'm going into technology. Well, I just don't go into semiconductors, or I just don't go into scan resources, or I just don't go into particular areas that are singular in nature. I might look on the input and output side of technology, right? The hardware and the software. Healthcare, you might look at pharma and biotech. Those are two different industries. So those are things that you want to be careful of. When you're looking at investments, you want to make sure you're looking at companies that have a little longevity with them. We don't want a lot of startups. Now, having said that, some of the startups today, rule about 60% of the S&P. Alphabet, Amazon, Microsoft, they were all startups at some point. But we don't want to put all of our money in one basket when it comes to our investments. We want to make sure we're diversified. Look for portfolios or investment strategies that support some of the advancements. So if we're talking about AI, for example, we've touched on this before, what would support AI? Well, you're going to need a tremendous amount of technology resources, right? You're going to need data centers. You're going to need energy. You're going to need bandwidth. You're going to need capability, cables, etc. And so when you look at an investment area like, for example, AI, maybe look at some of the ancillary support resources. Those could be the diamonds in the rough that maybe someone overlooked, but that's needed to make that sector grow. That's something that you want to look at. It's also clear that when you look at the fiscal policy of an entity, so let's say we're in a country where rates or interest rates are lower, so therefore money's more available, that might be a good move for you because that gives you greater opportunity and flexibility because you're looking at an environment that's maybe on the precipice of starting to expand. However, when you're in a country or an environment where money rates are higher, so those monetary policies have sort of tightened down on the money, that may be a country where they came off some type of correction or they came off some type of adjustment. And so it's important that you look at those two components because that helps you determine what's next. We want to make sure that when you're investing, that you're investing in areas that make you comfortable, but don't make you cringe. Remember, investing is sometimes driven by your emotions. So we get excited when we open our IRA statement or 401k statement, we see we're up 30, 40%. That's great. But when we open that same statement, we're down 10%, our tendency is to say, oh, I got to sell. I don't want to lose anything. And that may be the worst thing to do. So take time, sit down and write exactly what your time horizons are, write down what your mission or goals are, and then write down where your investments are set up. And look at how those line up with your objectives. If you have a very aggressive portfolio, yet you've got a very short window to use that money, meaning you may need it 1 or 2 years, you're probably not aligned. But if you're a younger individual and you've got the opportunity to sort of put money away, maybe it's only about 5 to 10% of your overall liquid net worth, and you're not needing this money right away to pay your rent, pay your car note or whatever, then you might be more aggressive. Gives you greater opportunity or propensity to get higher yields. And that's what's one of the critical things that we need to do for. When you also look at going back to the parts that support a particular investment revolution, because remember, that's part of the market expansion. Before a crash, you usually have some kind of revolution, something new came out. When you do that, do your research. Look at where are these entities getting their resources. For example, Meta is spending a tremendous amount of money right now, and so is Microsoft and other entities, on getting data centers, on getting energy support, because they know they're going to need that to remain competitive. So if you took a little time and Googled a little information, you might find 2 or 3 companies or uncover assets that you could invest in if you're trying to get into that sector and take advantage of it. Those are great opportunities. The other thing to be careful of is make sure you're looking at cash flow. So I'm not even talking about cash flow for the investment company, but your cash flow. If you have enough cash sitting on the sidelines to cover your bills for 6 to 8 months, if God forbid something were to happen where you lost employment, you're not going to be, and you shouldn't be, as concerned about a market correction. We've proven that every market correction comes back. And typically what will happen after a couple of months market correction, you'll end up having a bull market. The most recent one was one we had a couple years ago, and the bull market lasted almost 18 months. So when the market corrects, don't blink. Take the opportunity. If you have enough cash on the side, if you have enough resources with that money that's invested you don't need now, maybe you want to look at dialing down, sort of putting more money into those opportunities. So that way you know exactly what's going on. You've got an ability to maybe magnify your potential for growth. And you're not running for the doors like everyone else is when they look at those investment decisions. So those are some things that we think are critical for you and that really can help you. Again, we think that that's a situation where if you look at those investment considerations and you manage expectations, you'll be fine. So today we want to talk a little bit about tax shelter versus taxable. A lot of times people don't realize the impact to their finances or investments when it comes to the taxable income. So you'll have people who will say, well, I'm going to put my money in a high yield savings account. I'll get 3 or 4%. That sounds great. At least the money's making some money. And that's true. But here's the problem. With a 3 or 4% savings account, you actually have to receive the interest. It can't be deferred. It can't be put off. The bank actually gives you that interest immediately at the end of the term. Now what has happened? Well, you've taken the money that you didn't really need and you've created income. And if you're in a high tax bracket already, now you've created an income that has to be taxed. So even if it's only 3 or 4%, you've created an environment where now you are adding on to your tax bill, even if you didn't want it. CDs are another great example. Many individuals, including seniors, get sold into a CD. Well, I've got some extra money. It's sitting over here. I'm already getting taxed high because of my Social Security or other things, but I just want to make a little money, so I'll put in a CD. Well, here's the problem. The CD makes 3 or 4%. That's great. At the end of 2 years, you get a 3 or 4% payout. Well, when you get that payout, what happens? That's a tax. You're going to get taxed on that 4%. So did you really make any money? In contrast, let's say you invested it in the market and you didn't want it tax sheltered, so you didn't want it tied up, but you wanted access. Well, if you invested in positions that didn't sell dividends, so they didn't have a lot of dividend distributions, they were more of a capital gains type of account, you wouldn't get taxed on any of the growth until you decided to sell. So now you've got a scenario where you're investing your money, and in more cases, it's probably growing faster than a CD or savings, but every year you're not selling it. So there's no tax gain. There's no capital gain being distributed. So you're deferring, right? You're deferring your taxes. And here's the beauty of it. If you keep your accounts for a period of time, you go to a lower bracket when it comes to tax. All the money you get on a CD, all the money you get on a savings account is going to be taxed at ordinary income. But the money coming off your capital gains, depending on how long you're holding it, could have been taxed as long-term capital gains, which is considerably lower than ordinary income. So in that scenario, what did you do? Well, you built your assets quickly, you built them more effectively, and you minimize the impact of taxes. And the problem with taxes is taxes cut down on your growth. I don't care what anybody says. If I had a checking account that's taxable, and I had an account that's tax deferred, and that checking account's making, let's say it's making 4%. My tax deferred account only has to make like 1 or 2% to match it because I'm not paying taxes. Flip that around and let's say the taxable account's making 5%. I mean, the tax deferred account is making 5%. Your taxable account has to make almost 7%, depending on your bracket, simply because the impact of taxes. So when you're looking at investments and you're looking at opportunity, you want to look at tax strategies. You want to employ some of these strategies that can minimize your tax liability. And you can do it without tying it up in a retirement account. There are a number of different other tactics that we utilize. So hopefully that gives you a little bit clarity on some of the things you can do. Again, you're always welcome to DM us or email us for more specific questions. We'd love to answer it. Another thing that we see when it comes to individuals and when they have a large pool of money, their tendency is to want to pay off debts, and that's not a bad thing. But let's say, for example, they want to buy a house and they've got $400,000 and they want to put it on a house. Well, at first that might sound good, but here's another thing that we always tell people to look at. Try to use other people's money. What am I alluding to? Well, if I have the opportunity, let's say, to get a mortgage, and that mortgage rate is 4% or 5%, the $400,000 that I was going to use to buy the house cash only has to make more than 5% to make it worthwhile. What do I mean? Well, let's say I took the $400,000 and I invested it, and I'm able to get, a nominal return of 7 to 10% a year. So let's say we'll settle on 10%. And now I finance the house, and the house is at a finance rate of 5% or 6%. I'm still netting 4% in profit by keeping money in an investment account, building that investment, and financing the house. Now, to go one step further, I can make it even easier on my life, is I can take the interest. Remember, I only got to pay 6%. I can take that 6% out of my 400 grand that's invested, which is making 10, and I can use that interest every month to pay my payments. So now it's as if I have no house payment. But what do I have? I have two assets growing. I've got a house that's going up in value every year, and I've got an investment asset that's going up in value every year. So now I've created a dual approach to building wealth. And this is how many of the wealthy, particularly those in the real estate sector, get more wealthier. They don't use their own cash. They use finance rates. They use all kinds of structured accounts in a way that the assets that they own help pay for those assets, the fixed assets, and they continue to build their wealth over time. And it keeps them fully liquid. In the scenario I described, if something were to happen, God forbid, you have the asset, sure, and you may have to sell it at a loss, but you still have that cash sitting in your hand. You still can use that for an emergency or for some kind of acquisition or compensation adjustment. So these are unique tactics that we think you really should be looking at. And hopefully in our future podcasts, if you have more DMs, you can ask us. But you need to be concise and very focused on your investment objectives. But then you want to think outside the box. Look at opportunities and talk to individuals that are successful in those areas on ways to maximize your wealth and mitigate your expenses. So hopefully you like that. Hopefully you enjoyed it. We're going to go to our DMs now. We're going to take some questions from listeners, and we look forward to answering those for you. So let's go to our DMs. Grady, what do you have?
The UK pound has been taking a tumble. What does that look like for the US dollar, and does that spell bad news?
So whenever a currency fluctuates, there's a pro and a con to it. One is the pro, things that we buy cost us less, right? So if I go to Europe, for example, in this case, I go to UK and my dollar's got a higher currency exchange than theirs. Now I've got the opportunity to buy things and it costs me less, or I get more. The downside when you have that kind of high component could be inflation, because the cost of goods now coming in from those entities, when we're trying to sell our goods abroad, they may cost them more. So that could slow down some of the sales of goods. So it depends. I'm not overly concerned with the EU because until recently, we weren't we were a trading partner with them, but because of their taxes, a lot of those markets were not open to us. I think it could be a potential for opportunity of leveraging U.S. investments in that country or other areas. So we'd have to wait and see. But we always have these kind of currency fluctuations. As long as they're not long term, they're just really nominal impacts. What's the next question you have?
Next one's a YouTube comment. September has historically been the worst month for Wall Street. What do I do to combat the brokers returning from the summer?
So that's a good observation. Think about it. Everybody comes back from vacation or summer break, and it's like, trying to get back in the gym, trying to warm up and generate. I don't think personally, though, you should ever invest based on these market fluctuations that are low-keeled or nominal. So a little bit of a pause or a little bit of a light trading scenario in September doesn't impact your model. If you have a specific investment strategy, you have a way to invest. Let's say every month you invest, every week you invest, you're investing in particular sectors that you've done your due diligence on. Don't worry about September. And again, you want to think outside the box. You don't want to have a dynamic where other investors are making decisions for you. So I wouldn't be overly concerned with that. I'd probably be more concerned if there was some kind of election coming up or some kind of dynamic in the October, November markets, but we don't have that this year, thankfully. Good questions, though.
Last one. A report by the Good Food Institute suggests consumers are ditching plant-based alternatives. What does that mean for my wallet?
So there has been a lot of information coming out, right or wrong, about things like plant-based alternatives, and they've been somewhat negative. And the problem is when you have negative media on a particular emerging environment, that emerging environment can take a huge hit because it's a very small market. So I would personally stay away from those kind of areas just because of the speculative nature of the investments. You've got a lot of unknowns. You've got scientific unknowns. You've got the geopolitical unknowns. You've got the nutritional unknowns. There's a lot of dynamics that could work against you. That doesn't mean you can't invest in alternative spaces or longevity areas that you feel might be lucrative. But when you're talking specifically, for example, plant-based, that has sort of gotten a black eye in the last couple of months. And I would sort of be weary of that. I would really, be looking at areas that we know are a little more robust, like we talked about before, whether it's manufacturing, whether it's, semiconductors or alternative space. There's all kind of other resources out there. So I wouldn't wound myself up too much worrying about plant-based and getting into something that is so what we call tactical, because it is a very small niche market. So those are great questions. Thank you so much for all your questions. We always love our listeners looking at those things. We look forward to you talking to us next week. We hope you dial in, like we said, whether at YouTube, our Instagram, our Apple iTunes, Spotify. Thank you for listening to Watch Your Six. I'm Jason Edwards, and have a great week.